This is a great question and also a great opportunity simultaneously. And I'll take a stab at it from the point of view of an indexer, a guy who provides sovereign wealth and pension plan services. And if you're a country with a lot of oil, for example, and you want to invest in the S&P, you ask indexers like me to create an indice that is X oil, X airlines, and you just invest in that. And so it's always based on allocations, typical sovereign funds. And the reason I bring up pension and sovereign, they are the investors. I mean, for all the excitement about Bitcoin, nobody owns it. I mean, it's a nothing burger asset in the context of sovereign and pension wealth. 800 billion is nothing. I know that sounds trite, but it's true. And so the way to get this asset to be a part of the real investment world is to get it regulated. Any of these assets, pick one. I personally would like to see stablecoins regulated first because it's easier to do that, but whatever happens, we need regulation, because then here's why this works. So you want to have a 1% weighting in a $100 billion fund. A fund like that would have no more than 20% in any one of the 11 sectors of the S&P and no more than 5% weighting in any one stock or bond. That is a classic diversification strategy for long sovereign wealth, where trillions and trillions of dollars live every day. So they would like to have 1 to 3% in Bitcoin. It's the one they want to start with. It's the granddaddy crypto. It's the one that's the biggest opportunity, and the one that frankly the managers understand because it's been in front of everybody since the beginning of cryptocurrencies. If we get that regulated, they'll start putting on 50 to 100 basis point weightings. And then what you'll see happen, besides increased demand, you'll see less volatility, because when you have a 1% allocation, it sells down, you buy back to 1% by market close. And of course, crypto is 24/7. So they'll buy it back up to 1%. If it exceeds, if it jumps and doubles in price, they'll sell it back down. But they are the market, they are the bid forever. And everybody else benefits from the fact that the stability and the volatility is reduced dramatically, and the price will be significantly higher over time if, Mooch is right, and this is a property, they'll allocate it like they do real estate. And they could, in the context of crypto, go up to 20%, and I personally believe that crypto in the next decade will become the 12th sector of the S&P, because it is so strong a potential for reduction in fees, transparency, auditability, and just better financial services globally, that it'll make its way there. But it can't happen until somebody starts to regulate it. Now, good news, we've got the Loomis bill, we have the Haggerty bill, we've got the Toomey bill, we've got bipartisan effort. I think all three of us have been to the Hill multiple times to talk to these senators, to talk about, give us the code, regulate it, and then, when that happens, Katie, bar the doors. Watch what happens. I think it's that simple. I'm going to give you a real case study that happened last week that I think highlights why we need to get to what Jeremy's talking about. I do a lot of transactions in real estate in different geographies, and they're large transactions. And so generally what happens, you're going from one geography in US dollars to another geography in another currency. And so you have to transfer that money and to that new geography, then you have to FX it into the local currency, then buy the real estate. So last week we did and this bank is a large global bank, don't have to mention the name because the story's not nice, and we transferred millions and millions of dollars to its corresponding bank in another geography. They lost it. They lost the money for 48 hours, jeopardizing the closing of this transaction, and our team went out of their minds, including the Fed number, and they found it about 12 hours before the transaction was supposed to close, and they said, it was a back office error. I spent, even before the wire went, 18 minutes listening to a clerk read disclosure statements to me, which is a complete waste of both of our time. And I realized this is insane. This is before they lost it. And then we spent about 35 hours of staff time trying to find the money in their system. So, and I actually called one of the board members of the bank and said, have you ever heard of USDC? Have you ever heard of a stable coin? Do you know how it works? And have you done any work to try and figure out, because this is commonplace, this happens all the time. It happens with smaller amounts, but when it's a transaction this size, they owe me interest for 48 hours on millions of dollars, and we're going to fight about that too. And some kind of penalty I should impose to maintain our relationship after what they did. But the point is, that board member doesn't know anything about this. And those bankers got to get hip to this stuff, because they're going to get smoked if they don't provide service at some point. What I'm hoping from policymakers is to pick one thing and solve for that, then pick another thing, because crypto is so broad and diverse, and there's so many assets, and there's so much debate. You know, an NFT is, with utility, is that a security, is that a commodity, all those kind of things. Here's what I'd like to see happen, because for me the use case is so powerful, and it would also support the idea of maintaining the US dollar as a reserve currency globally. I'd like to, and I've read both bills, so I'm just giving you Cole's notes on what the Toomey bill and the Haggerty bill say about stablecoins. Not just USDC, all stablecoins. It's very simple. The Haggerty bill is 2 pages. Every senator can read 2 pages. And so the point is, they're asking for an audit every 30 days. What's wrong with that? Nothing. In fact, that would make you feel more confident about the asset. And secondly, they would like to have no underlying asset have a duration of longer than 12 months. No problem with that, right, Jeremy? That's not a big problem. And then just take that legislation and pass that one thing. Make that law for all stablecoins. Now, what would happen is, we all know that not all stablecoins are created equally, and if you're not willing to be exposed to an audit, then I certainly don't want to use you. You could still maybe go in a rogue environment, but I think that would immediately take, and in passing this bill, the regulator could say, we're going to license 10 stablecoins or 5 stablecoins and let them have little different attributes, just like a fund at Fidelity is a little different than Schwab or whatever, that's fine. But I don't want to see the government writing code. That's not what they're good at. Yeah. Let the private sector innovate with the legislation and let these stable coins flourish backed by the US dollar. 100%. Why wouldn't we all want that? I mean, that makes a total amount of sense, and I wouldn't be getting screwed on my real estate transactions. That's why I want it. And so, because it's a use case, and it's a very powerful one, and a lot of people then could take the benefit of being able to lend their stable coins and make 3 or 4% interest versus 20 basis points. That means they're losing 5% because of inflation. There's a lot of merit in picking one thing and forcing that through policy. And I think it's an easy use case. Everybody understands the value of a stablecoin. It's not as speculative. Its value after being audited certainly wouldn't vary that much. It would be the one thing. Now, we're not going to get any policy till the midterms are over, but that's not that far away. Then I think this bipartisan effort that Jeremy's talking about could get the one thing. Let's get one thing done. This sounds like one of those speeches back in the Apple days. One more thing. Remember that?
Yeah.
It's the same thing here.
If you enjoyed this video, make sure to leave a like, comment, and subscribe. We'll see you in the next video for more finance tips and up-to-date news.